Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid.
All right, I'm Michael Hartzman, along with Eric Wagoner, who's sitting in for Dominic Tavella tonight. And our guest this evening is Brian Fitzgerald from Franklin Templeton. Brian, thank you very much for making the time this evening.
Thanks, Michael. Good to be with you both.
Thank you very much. When Franklin told us they were going to make someone from the multi-asset team available, that's kind of one of my favorite categories. And you know, I get flooded with about 20 questions all at once because I could get to talk to someone who kind of has a discipline in all the different categories. So I'm not going to bombard you all at once, but I'll just give you an easy question right now, Brian. What are you worried about?
A great place to start. I think it's any given day we can turn on the TV, open up the newspaper, and there's something new that's front of mind for investors. I think last week it was the debt ceiling. This week we're looking at energy prices. Stagflation's come back into the conversation, and I think what's most important is we need to really draw the line in the sand between whether we're looking at true economic slowdown, right, the potential for things like a recession, or if it's just going to be a continuation of noise, for lack of a better term. Volatility is something that we're addressing, I think, here more recently. We've had an uninterrupted move in equity markets since last year. But all of a sudden September hits, we get 5% pullback. And the questions I'm dealing with is this the dip or is this the beginning to the end? And so what I'm worried about, candidly, is keeping investors kind of staying the course, right? Staying true to their asset allocation. Certainly, we have a keen eye on things like growth, inflation. We always want to be kind of in tune with what we're seeing out of Washington policy on both the monetary and fiscal standpoint. But our view right now is a lot of those still show green lights for an improving economy and portfolios that should continue to hold risk assets. And so I really, I think what we focus on most of the time is, again, drawing that line in the sand between what's the noise and what's the signal, and is our asset allocation really set up to continue to do well as the economy improves, because that's what we see.
I know Eric has some questions for you as well, but before I turn it over to him, just for the benefit of our clients and listeners, just tell us what the definition of stagflation is. I think that would help.
Yeah, so stagflation in its simplest terms is really weak or slowing growth, but increasing inflation, right? And that's kind of a recipe for disaster in the economy. Certainly something that's come up as a topic as of recent, I think, certainly because inflation numbers have been more persistent. You hear the word transitory. I think everyone expected as we entered here into the fourth quarter, a lot of these inflationary pressures to start to abate. We're also starting to see some adjustments out of just global growth, GDP to be more specific. I think, our view is that we're not really seeing weaker growth. Our view is that you can expect really across the globe for growth to remain above trend. Certainly we've probably reached peak growth, but over the next 12 months, we expect 4% GDP growth, which is pretty good. I mean, this is the strongest growth we continue to see in many, many years. And we, again, think that's a great sign for portfolios to be positioned to benefit from that. We often say, hey, we still have a risk on mentality, subsequently should own risk assets. And so stagflation certainly, I think, is going to be a topic we'll continue to debate. Again, seeing some of the flare-ups in energy prices. And as we all try to make sense of inflation, our view at the moment is it's more, again, getting back to this noise versus signal. It's more noise than signal.
Eric?
This is all good stuff. Now, how do you balance, let's say, fundamental analysis versus the psychological perception in the marketplace? And so you put together your portfolio, you do hopefully the fundamental analysis, and you think you've got some good names in the portfolio. They're going to continue making nice income, et cetera. But then, factor in the psychological part of it. And does that create a buying opportunity or selling opportunity?
Yeah, well, candidly, I think that's where probably we spend most of our time. Eric and Michael is really trying to really understand kind of the psychology of the investor. And I think September was a great example of that, where, even through most of the third quarter, we saw, coming into September, we saw 54 new market highs this year. We see 5% sell-off to kind of close out what was now an underwhelming quarter, but we were still positive for the quarter, and that marked 6 consecutive quarters of gains in the S&P 500. But a little bit of volatility, and now everyone wants to, again, start predicting recession, start predicting end of the world. Candidly, I think it's a great opportunity to remind investors that volatility is part of the game. Right? If I'm going to borrow a statistic from our friends at ClearBridge, one of the specialty investment managers, part of the Franklin Templeton family, but they did a study going back almost 40 years back to the early 80s, and the median average market return for the S&P 500 is 15.5%. Pretty good if you ask me. But the median peak to trough intra-year decline in the S&P 500 was 10%. Peak to trough down, so negative 10%. We've only seen 5, and you're hearing a lot of calls for doom and gloom. Again, where we sit at Franklin Templeton, we specialize in strategic asset allocation with dynamic tilts, right? Setting people up for a diversified portfolio, geared to meet a particular goal, whether it's capital appreciation or income. And our hope is that we can dynamically tilt the portfolio over time without having to disrupt the strategic asset allocation. And it's our view that really through market volatility, you can readjust the portfolio on the margin, but overall, not a lot of changes are needed.
One topic that Dominic and I talk about all the time, to your point, is the sell-offs that we've had in more recent years are more violent, they're quicker, and the market rebounds a lot faster. I had a client say to me the other day that there's not even any time to buy in the dips anymore. So do you kind of see the makeup of the market changing a little bit, where you don't see that 2000 to 2002 sell-off, or even where the market seems to sell off in days or weeks or a few months, and then kind of where it digests it and we're off to the races again?
Well, what's unique is when you look at the surface level, not a lot has changed, right? Again, we saw 54 new highs. We're only 5% off, give or take, from the most recent high. But when you pop the hood, when you look underneath, you actually have seen a lot of just general rotation across styles, across different leaders. When you look at the S&P 500, when you look at the NASDAQ, even when you look at the Russell 2000, the small cap index, you have seen a lot of names actually come down 10 or 20%. But at the overarching index level, you're not seeing that. Mm-hmm. For us, that's just case in point of why you need a good active manager really at the helm. And we specialize, again, at kind of the asset allocation guidance, setting that, and then relying where we think necessary on active managers to take advantage. Certainly, I think we're in a secular bull market, and so kind of these prolonged sell-offs that give people enough time to really make sense of really what's going on, and should they have cash to deploy to get in. I think we're kind of in a market right now where you're going to see, again, because I think the macro signs point to continued progress, you're going to see people come in and buy the dips as we do see volatility.
Okay. Eric?
Now, people have a lot of cash, and that's one thing that gives you an argument for the market being able to maintain and support itself and not have the volatility like we've seen before. But if by chance this cash gets invested, then is that a point in time we might get nervous and worry about the fundamentals change and people being fully invested and wanting to get out? Or how do you factor that into the investor strategy?
No, that's a great point. You bring up really kind of 2 points, which is one is I think just excess cash. We talk about how even as we've seen peak growth, you can point to the consumer, $2 to $3 trillion of excess savings, household net worth at all-time highs. Naturally, that makes people, I think, more confident. That has certainly some extra money in the pocket that they can put into the market opportunities they think so. I think the caveat to that is we don't necessarily see or feel true euphoria, too much optimism in the market. You can look anywhere from the options market, looking at the skew index, to just how some institutions are positioned. We don't necessarily feel that it's become overextended in that right. Thinking about just from a fundamental basis, when people are fully invested and when we could see things roll over, we're going to trust kind of more the macroeconomic outlook for that. The decision on whether we've reached a true recession and whether we need to start positioning accordingly.
So, Brian, let's get a little more granular about your category, the multi-asset category. So I'm assuming that at Franklin Templeton, you guys have a benchmark for fixed income to equity exposure, and then you guys have the real world of where the fund kind of ultimately lands. So I guess my question is, where did the fund start in terms of the fixed income to equity mixture, and where are you now as it relates to where you started from?
Certainly. So, I'll answer that kind of in two ways. First and foremost is, so Franklin Templeton Investment Solutions is the multi-asset division of Franklin Templeton, $130 plus billion today. So an important part of the overall organization. And I'll just kind of very quickly lay out that our multi-asset solutions span a number of different end clients, outcomes desired, implementation types. Which I think, kind of just speaks to the breadth of our platform. Speaking to a lot of, let's just say, the model portfolios we're running for your everyday investor. If we just start with the 60-40, I think
60
that's
equity, 40 bonds.
Exactly. So 60 equity, 40 bond. Today we carry a 4% overweight to equity. So 64-36. Again, I'm just going to take you from kind of the top to bottom. Our view is we still think things are pretty good. Things are improving. The first decision you make at the portfolio level is how you want to balance out that equity fixed income breakdown. And so we've elected to carry an equity overweight. Then you start making decisions intra-asset class within both equities and fixed income. And within equities, we typically just high level think about it. You have your US, you have your international developed, and you have your emerging markets. And currently we remain overweight and positive on the US. We're neutral on international developed, and we carry an underweight in emerging market equities. And then within fixed income, our view is the natural path for interest rates is higher. You have spreads that have come way in. Our overweights, our areas of higher conviction are in high yield and emerging market debt. We're neutral on international bonds, and we actually carry an underweight to some of the higher quality investment grade, again, because we want to remain underweight duration. The last thing I'll add is just because we may favor equities less than fixed income, we certainly recognize that bonds play a very important role in all portfolios. Again, we're only underweight the strategic asset allocation by 4%, and we're getting pretty selective, relying on active managers within that asset class to set us up accordingly.
So, follow-up question: if you're underweight emerging market equity but overweight emerging market debt, is it emerging market debt? Is it the country debt, or is it corporate debt? Because I'm just curious what the disconnect is. Why you would be bearish on the stock market but bullish on the bond market in a similar category?
No, great question. Why we are bullish on EM debt is essentially it's a great place to go get carry, so a little bit of extra yield. Also, typically emerging market debt carries a little less duration, right? So interest rate sensitivity. The emerging market equity, that's very heavily weighted to China. China, while second largest economy, fastest growing, is going through really kind of a transition, led by the government. We've seen regulatory crackdowns. I think just in general, emerging markets from an equity perspective still remain challenged with COVID, certainly the supply chain issues. And so it is an interesting dynamic. Again, it's about what we can get from a return and risk perspective back to the portfolio. But very astute to point that out. And again, really just kind of a a factor of really where markets are globally.
Mhm.
Now, I've got a question about the fixed income. I do a lot of high yield bonds. If you're putting together a portfolio, do you have investment grade bonds? Do you have double B or single B, or what kind of high yield bonds do you have? And also, do you look at like a particular maturity, like 3 years, 5 years, 7 years? So I guess the investment quality and also the in this case, the duration.
Sure. So so certainly I think in any, in that 60-40 or that 64-36, we're going to hold fixed income securities that are both investment grade as well as high yield, as well as international and EM. It's really the weighting where we're taking an active approach. And candidly, we typically rely on active managers for that to make those decisions. I know there's been a lot of opportunity, kind of, the fallen angels right there in kind of the single B opportunity. But candidly, I can't really speak to the duration because we rely a lot on our active managers to make those decisions for us.
So getting back to the equity side, can we talk a little bit about sector rotation? I mean, energy is getting a lot of play right now.
Sure.
That seems to energy's kind of given us a head fake a couple of times in the past few years. So where is Franklin in terms of possible sector rotation?
So so from a sector rotation, and I'm actually just gonna only because I heard it yesterday and it's been so interesting to me, I'm just gonna rattle off kind of a quick statistic. As of yesterday, over the last year, Zoom video, which was the world famous stock through the pandemic, is down almost 50%.
Mhm.
You have Amazon, which is down almost 5%. And you have small caps up, let's call it 45 or 50, and energy up over 90%. And the only reason I bring that up is it's just kind of it's a very interesting, it's more of a thought exercise on how much the market dynamics have changed just in 12 months. Energy is getting a lot of attention, certainly not only because of its market performance, but because of some of the price inflation we've seen across a number of different aspects. I'd say from a sector perspective, we've actually started to take a kind of a more even, more balanced approach. The question I get probably more than almost any other is, do you like value or do you like growth better? Right. And we know that value tends to do very well coming kind of out of a recession. Growth tends to do well when economies slow down, when PMIs peak. We think we're kind of smack dab in the middle, mid-cycle. And these are opportunities, and we've seen it this year where you're going to see kind of growth and value flip-flop. Subsequent sectors are going to kind of flip-flop, and I'm talking more market leadership. Last time I checked, value and growth were both up mid-teens this year, so pretty good returns, but certainly not lopsided like we've seen for the last number of years. And where we've started to position portfolios is more in high-quality names, which actually pulls from both the value index and the growth index. And what you see there is we're now at a part of the market cycle where market participants are going to be really focused on earnings. Certainly earnings is we're entering earnings season right now. We've seen record earnings coming out of the recession, and where we can continue to see market beats and earnings revisions upward, we think is really the best place to be positioned.
So at the end of the day, it really is individual stock selection. We really can't get caught up on following the herd and just picking a sector and going all in.
I think the time for I think active management's time is certainly come right now. Even within large caps, we are at a point again where I don't think you're going to see very unique leadership in the market where you could play it with just kind of a pure beta play or a cheap passive allocation. I do believe you need true active management. That's how we've elected to allocate within our portfolios. And again, you just want to have that preference for quality because we're at a point in the cycle where we're names that can continue to generate earnings, but I also think, frankly, manage this inflationary environment. Manage not only higher costs to their business, but also maybe pass on some of those costs to the consumer. You're going to have to get picky. You're going to have to, rely on active management to really put those together for you in a portfolio.
Fundamental analysis is always going to be the big important factor. to your point. So
That's
you
it.
got to know
So-
what you're buying and why.
So we're out of time for the first segment, Brian, but you could stick around, correct?
Yes, I can. Yeah,
I
looking
had a
forward to it.
Bunch more stuff to cover with you. So we'll be right back right after this quick break with Brian Fitzgerald.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, LETAX.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's LETAX?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Eric Wagoner, our co-host tonight, sitting in for Dominic Tavella and Brian Fitzgerald from Franklin Templeton. Brian, I have to ask you the question that's been getting a lot of headlines for years now. Jamie Dimon made a comment yesterday, which created more headlines. I want to get yours of Franklin's interpretation or impression of Bitcoin. Jamie Dimon said, I think yesterday, that I don't know if it was his personal opinion, which I think it was. I don't think it was JP Morgan's official opinion, but JB Dimon is a pretty powerful guy, pretty smart guy, as you said earlier, that Bitcoin is not an asset class or not an asset. And I was just kind of wondering what your opinion of Bitcoin is. Does it fit into a portfolio? And if it doesn't now, will it in the future? And you know, how ultimately do you see the Bitcoin story unfolding?
Yeah, it continues to be a red hot topic. And certainly anytime Jamie Dimon lends his perspective, it gets attention. I'm not sure it's an asset yet, but I think the thought exercise is certainly certainly one worth doing. We at Franklin Templeton Investment Solutions, have not considered cryptocurrencies as a possible inclusion in either a retail or an institutional asset allocation. With that said, when you think about kind of really the foundation upon which asset allocation is based, modern portfolio theory, really what that theory states is that you should maximize your return given a level of risk, and the ability to, or how you manage that risk is best done through diversification, right? You shouldn't think about individual volatility from a particular asset class, because it's really about the volatility of the portfolio as a whole. And we know that by including uncorrelated assets, you can reduce that volatility. And so when you think about the universe of asset classes any given investor can allocate to, historically it's been, let's say, a geographically diverse set of stocks. You can include bonds of different investment grade levels. You can factor in things like real estate. Well, what you realize is that the higher return assets tend to be more highly correlated, right? And so a diverse portfolio, your return profile tends to come down. And really the thought exercise here, all it really drives to is, can cryptocurrencies become an asset class in the mix, right? Higher volatile, but negatively correlated. And as of recent, Bitcoin, by example, has produced some pretty high returns. And so it does get one thinking that, at these levels, I had heard, now $1 trillion market cap. Again, certainly if Jamie Dimon's talking about it, certainly it's really become, it's proven its validity. Is it worth considering, carving out within a portfolio, because it is, again, negatively correlated, but does deliver a high level of return, and again, just plays into that kind of modern portfolio theory.
It would have to be the ultimate negatively correlated asset class there is, because there's nothing to compare it to, correct?
It's going back again. Bitcoin's not been around long enough. I mean, we look at the asset classes, pre-Bitcoin, the ones that Harry Markowitz were considering. Stocks and bonds have hundreds of years, going back to see how the returns have moved around and the correlations from which you can derive. Bitcoin hasn't been around all that long, right. And so certainly you can kind of question the studies on that. But in its short life, it has had, at times about a zero correlation, and certainly in some pockets, positive and negative. But again, it's about introducing an asset class that not only has, for the most part, let's say a zero correlation, but also a higher return profile. And again, not to be too worried about the extreme volatility, because that's the power of diversification. You introduce a higher volatile asset class, but hopefully the portfolio of lowly correlated asset classes kind of drowns that out.
And I know Eric has a question for you, but to me, my last point about Bitcoin, then we'll move on, is to me at the moment, and I talk to my clients every day about this because they ask me every day, Bitcoin to me can be comparable to gold or silver or oil even. It's a commodity. And I think until it's more regulated, it's not going to be considered a common currency, because it's just so volatile on a daily basis.
Well, I think that's what we're seeing currently, right? The new SEC chair has kind of been out, front and center on wanting to get smarter and ensure that to the level that cryptocurrencies are widely used and approved, that the SEC certainly has some oversight, certainly taking kind of that consumer protection stance, but we'll see if that's really kind of the next step, the next evolution for the cryptocurrency.
Mm-hmm. Eric, you have a question?
When you're working with a customer or client, to what degree do you get into the investment time horizon? Do you talk to a guy about 1 year, 3 years, 5 years, and kind of what his long-term expectations are, and then the next step of that is listening to what his thoughts are. How do you diversify and put together a mixed portfolio that meets his needs?
Well, that's a great question, Eric. Our view is, we work hard, again, kind of behind the scenes, almost before we've even sat down with a client, on getting a good understanding of what our capital market expectations are for a number of asset classes. Those are typically 7 to 10 years. Then we produce asset class views, and even portfolios with more of a kind of a dynamic view. Let's talk 12 months out. I mentioned earlier, we had taken our 60-40 to a 64-36. That's really on a 12-month view. When we sit down, I think the beauty of multi-asset solutions is, there are a number of ways you can meet an investor's needs with a diverse portfolio. More often than not, investors are kind of taking that longer term approach. And so we need to remind them about things like, the September volatility. But what we typically do is we typically try and derive, like, what's the outcome here? It's a general capital appreciation at a certain risk level. Are you looking to meet a particular outcome, like income? That's probably the first and foremost outcome most investors are looking for as they get to and through retirement, is replacing the income from their paycheck to what they can earn off their portfolio. And once we understand that, we can really back into what we believe is a healthy asset class mix that's diversified, that we think can both, certainly grow over time, react accordingly to different market dynamics. And in the event that income is important, also produce a healthy amount of income for that person.
Thank you.
Brian, let's go back to fixed income. You touched on it a little bit earlier. So what's Franklin's position or your position as it relates to interest rates? Let's start with interest rates, and then we could go into different categories.
Sure. So our view is the natural path is higher from here. Our next 12-month estimate on the 10-year is 185, so 1.85%. And so naturally, you see us holding underweight to duration in our portfolios. What we've seen is that tends to kind of fall smack dab in the middle from some of the other big banks that have been out there putting estimates out there for people to see. And given where interest rates are today, I think it was high 150s, maybe even 160. We don't have a long way to go to get there.
Right.
The interesting thing is it feels like a long way to go, except for when you take kind of a wider lens and you realize just still how historically low interest rates are, and really still how challenged both savers and those looking for income truly are when it comes to investing in fixed income. And again, I think that's why we have favored more spread product, things like high yield, even things like bank loans. And again, really, I think the case for even a multi-asset product, we think about how many people just a few decades ago relied on one asset class for income, that being fixed income, and now have to take more of a multi-asset approach to meet the income needs that they have to hit.
Do you have an opinion on municipal bonds? I mean, we're all in, you're in New York City, so you're in the highest tax bracket, hopefully, that there is between city, state, and federal. We're on Long Island, Eric's in Connecticut. So what's Franklin's opinion on municipal bonds as it relates to clearly income taxes going up next year as well, in addition to interest rates?
Well, certainly, I think that'll create, the demand for them even more so than we've seen. Municipal bonds play such an important role, I think, at the high net worth level when it comes to asset allocation and figuring out within the fixed income allocation, how one can not only deliver a level of income, but also withstand any sort of tax implications that high net worth individual may have. We benefit from actually two great municipal managers, of which have been key components for us in our asset allocation, both Western Asset and Franklin Fixed Income. Off topic, I can't speak to kind of the latest and greatest on how they view, but I do know, again, from the asset allocation seat, how important managing taxes, not only today, but certainly as we head into next year, where taxes both at the corporate and individual level are going to be front and center for investors and necessarily need to be managed.
Eric?
I got a crazy question. Given the fact that certain people in DC are suggesting maybe taxing unrealized gains, have you looked at that, and do you have an opinion on that? And what do you think that would do to the market?
I'd be shocked if that really came to fruition. I think kind of our approach as of late, and I think just last week, the debt ceiling is a great example. You certainly need to take everything seriously coming out of Washington. It's been really hard to handicap, I think, from an asset allocation perspective, an investment perspective, really how to, we don't want to over trade portfolios given kind of proposed legislation coming out of Washington. Again, I think the debt ceiling is a great example of, I think we're going to have greater clarity on what the Fed's going to do than we'll see out of, coming out of Congress. And so something we'll certainly be attuned to. Again, I'd be, personal opinion here, be shocked if that's something we actually saw, but not something we're going to necessarily, trade portfolios around, given its level of popularity in terms of what's being covered on the news or what's even they're deciding to propose.
Yeah, well, I hope it doesn't happen either.
Yeah, you and me both.
Yeah, you know what, Eric, I didn't even hear that one. I don't even know how you would tax unrealized gains. I don't even know what you would base that upon.
Well, you'd have to sell what you got to pay the taxes, and that would be a negative on the market.
Oh, it would be a disaster on the market. I can't even imagine that getting any traction in Washington whatsoever. But
certain parties are proposing that, so it's.
I don't know. You know what? At the same time, guys, I think every year Congress also floats making municipal bonds taxable, and then all 50 governors have a fit, and that goes away as well.
Yeah, true.
So Brian, we're running out of time. If we were going to put a bow on this, I know we wandered all over the place, and I really appreciate that. But if we were going to put a bow on this, the one comment I heard you make earlier was you saw all green lights. So, and Franklin was still optimistic. So just for the benefit of our listeners, could you just kind of, if you could, tick off what those green lights are?
Certainly. So, I'd say from a macro perspective, we look at really, certainly among many other things, but we tend to look at global GDP growth. We look at inflation, and we're looking at policy. And across all three, we think those are still supportive of a risk on bias and holding risky assets in a portfolio. Naturally, we think you should have a little bit of a tilt towards equities over fixed income. Again, I think a lot of that's driven by the macro environment we're in. But when you just compare the two asset classes, expected returns on a go-forward basis, even valuations point to equities as a more favorable option within portfolios. And, I think the last thing I'd say is, I think volatility is very normal. We're just starting to see that again. I think that's actually a good sign for equity markets and investors at large. It kind of wakes them back up to what's really a normal experience in the stock market. But I think as we get through earnings season here, continue to see strong earnings. I think continue to see strong progress with things like the pandemic. I think investors are going to be pleased that they've kind of stayed the course and stayed true to their asset allocation.
So at the end of the day, you mentioned that your prediction for the 10-year in a year from now is 1.8 something.
Yep.
At the end of the day, why would you still buy a 10-year note that's going to guarantee you to pay you less than 2% for 10 years? So as long as money stays cheap, I still think the market has some room to grow. Is the bottom line, what I think I heard you say.
And that's it. And that that kind of falls into policy, right? It's even as the Fed begins to taper, it's an extremely accommodative environment, and that certainly supports equities. Certainly supports equities. With regards to why you would buy a 10-year, from a return potential, certainly I think we can all agree it's not the most attractive option out there. But naturally, bonds do have a place in a portfolio.
I agree.
And a good active manager can incorporate some government securities, some investment grade, along with other things that bring return. But at the end of the day, serve as a nice ballast, kind of a counterpoint to your risky assets.
Exactly. Brian, on that note, we can't thank you enough. Thank you for your time this evening. And
Brian, thank you very much. Very nice.
Thank you, Michael. Thank you, Eric. Great being with you.
Thank you.
We'll be right back. When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the funds is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
for
taxes.
your cash.
More
Ask your advisor
Less
about the Lebenthal
More
Ultra Short
income.
Tax-Free Income
Telling you,
Fund,
less taxes.
or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund. Symbol LETAX.
The tax.
Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Eric Wagoner. And Eric, I think you would agree that Brian, we covered a lot of territory. We wandered around quite a bit, and I think he did a pretty good job. I think he did a great job.
I think he did a wonderful job, and he explained his investment strategy, his process, and how he looks to help people manage their money. So I thought he did a good job.
You know, it's always, the easy thing for a manager or portfolio complex, a mutual fund complex to say is we see green lights everywhere. He didn't see them everywhere. There were definitely things to worry about. Recession, inflation. I don't think there's a recession anytime soon. I think that's pretty obvious. But still, stagflation's out there. Interest rates are out there. But I think he made a good case for why those green lights are real as well. And clients, shouldn't panic.
Yeah, there's liquidity. I think fundamentally businesses are doing well, earnings-wise, net income. So I think that we're in a situation where the economy is good, and hopefully the people in DC don't mess it up. So, but I think we're doing well. So,
but to your point earlier, worrying about Washington is exhausting because I don't think there's ever been a time, and you've been probably in the business 10 years longer than me. I don't think there's ever been a time, Eric, where there was not anything to worry about that could come out of Washington. There's always something to worry about.
I agree, 100%. Yes.
Again, and that's whether Republican or Democrat, there's always something happening, whether they're going to fiddle around with Social Security or fiddle around with the taxes or infrastructure. There's always something that they're either kicking a can down the road on or trying to screw up something that doesn't need to be fixed.
Yeah. Well, in this phase of the economy at this point in time, it's not like 2009 or 2000 or 2020, 21 or 2001, 2002. I think we're in a healthy economy, and there's a lot of cash out there, and a lot of people looking for good opportunity. And I think there's a lot of good businesses that are doing well, and they're going to continue doing well.
And I don't want to get lost on that, Eric. You are Lebenthal Financial's resident bank expert. So, you were right in the middle of this whole thing in 2007 and 8 and leading up to the crisis in banking and then the recovery. So when you say this is not a 2008, people really ought to pay attention because you were knee deep in that back then, weren't you?
Yes. And luckily I was on the right side of it most of the time, but in those days, people were leveraging mortgage portfolios and they were borrowing money against it. And sadly, a lot of the banks didn't really know what they owned. And the federal government came out and basically changed all that. So now banks have to have a tier 1 capital and a certain percentage of ROE, and they can't really get out and buy speculative mortgage portfolios like they were doing in 2006, 7, and 8. So, it's a different era. And the NIM, the net interest margins in those days would be 4%. They went to 1%, but now they're back to 2.5%. So, but it's more conservatively managed. And I don't think there's a situation where there's a event that's that we're not managing and working, being able to manage and work for. So the banks, I think, are healthier now than they were. And if they can continue their ROE and their growth in net income and maintain their margins, it's not a bad place to have some of your money. So,
And we both are smart enough to know that we say that will never happen again, meaning the banking crisis. But is it safe to say it's unlikely it'll ever happen again?
I think it's the way it happened in 2007, 8, 9. I think it's very unlikely and a very low probability that something like that could happen again. It was like a margin account, and you had to sell out on your margin account. So it's, if you had an account at Merrill Lynch and had on margin and everything fell out of bed, you'd have a margin call.
Right. So Eric, I can't thank you enough as well. You made the time this evening to pinch it for Dominic kind of at the last minute. And I appreciate you throwing on that jacket and sitting with us and chatting this evening and enlightening our clients. So thank you very much.
Well, thank you for having me, and let's make things happen. So thank you.
You're welcome. And I will be back next week with Dominic Tavella. Have a good night, everyone, and we'll see you down the road.
Thanks for tuning in to the Lebenthal Report.